Hello and welcome to another video. Today's video is all about investing and investing for beginners, UK investing. So let's get started. In the world of finance, investing can seem like trying to understand an ancient language. Terms like equities, fixed bonds and fixed income, derivatives and treasury can make it feel overwhelming and confusing. But don't worry, in this video I will try to make it as simple as possible, because the thing is, the finance world uses a lot of jargon to make it seem very complex when in reality it really isn't. It's just money. You're making money or you're losing money. That's pretty much all investing is. So let's start off by breaking down the different types of investments. At the core of investing are asset classes. These are like the building blocks of your investment portfolio, each with its own characteristics and potential for making money. Now, there are 5 main types of asset classes to know about. And those are 1. Cash, 2. Equities, 3. Fixed income, 4. Real estate, 5. Commodities. Cash, this is the most straightforward form of asset. It's the money that's in your bank account. It's the money that you have in your pocket. Equities, these are shares in companies. Fixed income are such as bonds that offer you a fixed income, hence the name. These are investments where you lend money to governments or companies in exchange for interest payments. Real estate, as you know, housing, commercial properties, and commodities are oil, gold, livestock, stuff like that. Don't worry, I'll go more into detail. That's the overview of it. Now, once you understand the different type of assets, you can create a balanced investment strategy based on your goals and how much risk you're comfortable with. So let's start off with cash. Cash is one of the simplest forms of assets and refers to the money you have readily available for spending or investments. Cash is highly liquid, meaning it can be easily converted into goods, services, or other assets without significant loss of value. You can access your cash quickly and use it for various purposes like paying bills, making purchases, or investing. Cash can take various forms, including physical currency like coins and banknotes, and digital money like funds in your bank account or digital payment platforms. It's the most liquid asset because it's widely accepted as the medium of exchange. Cash is generally considered safe because it's not subject to market fluctuations or investment risks. And unlike investments in stocks or bonds, the value of cash remains relatively stable over short periods, although it can be eroded by inflation over time. Not it can be, it does. It gets eroded by inflation over time, which is one of the downsides of holding cash. The risk of losing purchasing power due to inflation. Inflation is the gradual increase in the price of goods and services over time, which means that the same amount of cash will buy less in the future. Therefore, keeping too much cash without investing, it can lead to a decrease in its real value over time. Holding on to cash may also entail an opportunity cost. Instead of keeping cash idle, you could potentially invest it in assets that generate returns, such as stocks, bonds, or real estate. By missing these investment opportunities, you may miss out on potential growth or income. But despite the risk associated with holding cash, it's essential to maintain an emergency fund consisting of readily accessible cash reserves An emergency fund provides financial security and can cover unexpected expenses like medical bills, car repairs, or job loss without having to resort to high interest debt or selling your investments at a loss. Now, let's look at equities, often referred to as stocks or shares. Stocks and shares represent ownership stakes in companies. So, when you buy shares of a company's stock, you're essentially buying a portion of ownership in that company. This ownership entitles you to a share of the company's profits, as well as a certain voting rights in corporate decisions such as electing the board of directors. Equities can be classified into different types based on various factors, including company size, growth potential, and dividend payments. Common types of equities include common stocks. These are the most typical type of equities, representing ownership in a company and offering the potential for capital appreciation and dividends. Preferred stocks. Preferred stocks also represent ownership in a company but typically offer fixed dividend payments and priority over common stocks in receiving dividends and assets in the event of liquidation. Blue chip stocks. These are shares of well-established, financially stable companies with a history of reliable performance and dividend payments. Growth stocks. These are shares of companies that are expected to grow at an above average rate compared to other companies in the market. They often reinvest their profits to fuel expansion rather than paying dividends. Value stocks. These are shares of companies that are considered undervalued relative to their fundamental, such as earnings, dividends, and book value. Now, risk and return. Investing in equities involves a trade-off between risk and potential return. Stocks are considered riskier investments compared to bonds or cash equivalents because their prices can fluctuate significantly in response to changes in the company's performance, industry trends, economic conditions, and investor sentiment. However, equities also offer the potential for higher returns over the long term to compensate for this higher risk. Market volatility. The prices of equities can be volatile, meaning they can experience rapid and significant price fluctuations over short periods. This volatility can be driven by various factors, including company-specific news, macroeconomic trends, geopolitical events, and changes in investor sentiment. Investors should be prepared to tolerate this volatility and take a long-term perspective when investing in equities. Now, investing in a diversified portfolio of equities can help reduce the risk by spreading exposure across different companies, industries, and regions. Let's look at fixed income investments. Fixed income investments are a type of asset class that involves lending money to governments, corporations, or other entities in exchange for regular interest payments and the return of the principal amount at maturity. So, the types of fixed income investments are bonds. Bonds are debt securities issued by governments or corporations to raise capital. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments, known as a coupon payment, and the repayment of the principal amount at the bond's maturity date. Treasury securities. These are bonds issued by the government. Treasury securities are considered to be among the safest fixed income investments because they are backed by the full faith and credit of the government. Corporate bonds. Corporate bonds are issued by corporations to raise capital for various purposes, such as financing operations, expansions, or acquisitions. Corporate bonds typically offer higher yields compared to treasury securities to compensate investors for additional credited risk associated with corporate bonds. Certificate of Deposit (CDs). CDs are time deposits offered by banks with fixed terms and interest rates. In exchange for depositing money for a specific period, the investors receive interest payments at regular intervals and the return of the principal amount at maturity. Essentially, Certificates of deposits are savings accounts that hold a fixed amount of money for a fixed period of time with the promise of a guaranteed return rate. Fixed income investments provide a predictable stream of income in the form of interest payments. The interest rate or coupon rate is fixed for most bonds, meaning investors know how much income they will receive over the bond's terms. This makes fixed income investments particularly attractive for investors seeking steady income or looking to diversify their investment portfolio. Now, let's look at real estate in the United Kingdom. So first, let's look at residential real estate, the housing market. The UK housing market includes a mix of residential properties, including houses, flats, and other types of dwellings. The market can vary significantly in terms of prices, demand, and rental yields across different regions of the UK. Home ownership is a significant aspect of the UK real estate market, with many individuals and families aspiring to own their own homes. The UK government provides various schemes and incentives to support home ownership, such as Help to Buy and shared ownership programs. The rental market in the UK is robust, particularly in major cities like London, Manchester, and Birmingham. Buy-to-let investments, where investors purchase properties to rent out to tenants, are common. Rental use can vary depending on location, property type, and demand. You don't just have to invest in residential real estate. You can invest in commercial real estate, so office space. Major cities in the UK, such as London, Birmingham, Manchester, are home to vibrant commercial real estate markets with high demand for office space. London's financial district, known as the City of London or Canary Wharf, is a major hub for corporate offices and financial institutions. Retail properties. Retail real estate includes shopping centres, high streets, and retail parks. The retail sector has faced challenges in recent years because of the internet, but is still a key aspect of the real estate landmark. Industrial and logistics. Industrial and logistic properties, including warehouses and distribution centers, play a crucial role in the UK's supply chain and logistic infrastructures. The growth of e-commerce has led to increased demand for industrial properties, including to have them in strategic locations with good transport links to major cities. But if tangible real estate is not something that you are keen to invest in, you can also invest in real estate investment trust, REITs. REITs are publicly traded companies that own and manage income-producing real estate properties. UK REITs offer investors exposure to various sectors of the real estate market, including residential, commercial, and industrial properties. You can invest in property development. Property development projects, including residential, commercial, and mixed-use developments, present opportunities for investors and developers to create value through construction, renovation, and redevelopment projects. You don't do any of that. You just provide the capital, the money, and let other people do the work, and you just gain the rental income or the sale income, the capital gains. You could also invest in student accommodation. So the UK has a significant market for student accommodation, with demand driven by domestic and international students attending universities all across the country. Purpose-built student accommodation, PBSA, is a specialized sector within the real estate market offering investment opportunities. But as with everything, there are regulations and taxations. So stamp duty land tax, that's what it's called, SDLT, is a tax payable on property transactions in the UK. The rate of stamp duty vary depending on the property value and the buyer's circumstances. So if it's your first property, second property, or if it's a buy-to-let. There are also landlord regulations. Landlords in the UK are subject to regulations governing rental properties, tenant rights, safety standards, and property management practices. Compliance with regulations such as the Housing Act and Energy Performance Certificate (EPC) requirement is essential for landlords. And if none of that takes your fancies, then you can invest in commodities. Commodities are raw materials or primary agricultural products that can be bought and sold in their basic form. So, types of commodities, let's look at energy. This category includes commodities such as crude oil, natural gas, heating oil, petroleum, just to name a few. Energy commodities are vital for powering industries, transportation, and heating/cooling homes and businesses. Metals. Commodities include precious metals like gold, silver, and platinum, as well as industrial metals like copper, aluminium, zinc, and nickel. Precious metals are often used as stores of value and for jewelry, while industrial metals are essential for manufacturing and construction. Agricultural commodities include crops such as grains, wheat, corn, rice, soft commodities, cotton, sugar, coffee, livestock, cattle, sheep, and dairy products, milk, cheese. These commodities are fundamental for food production, livestock feed, and textile manufacturing. Livestock and meat. Livestock commodities include live animals such as cattle, pig, and poultry, as well as meat products like beef, pork, and poultry. These commodities are traded for consumption and industrial use. Physical versus financial commodities. So physical commodities are tangible goods that can be physically delivered and consumed, such as barrels of oil, bushels of wheat, or ounces of gold. Trading in physical commodities involves the actual exchange and delivery of the underlying goods. Financial commodities, also known as commodity futures, are contracts that represent an agreement to buy or sell a specified quantity of a commodity at a predetermined price on a future date. These contracts are traded on commodity exchange and serve as a way for investors to speculate on price movements without taking physical delivery of the underlying commodity. Example: say you have a bag of sugar that is selling for £1, and we make a deal that I will buy that bag of sugar next week for £1. Now when next week comes and the price has gone down to 50p, I still have to pay you £1 and you make 50p profit and I take a loss. But if the price has gone up to £1.50, then I still only pay you £1 because I have the contract and you take the loss. Anyways, futures are risky and complicated, and I don't know enough about them to really go into more detail. Now, apart from the mainstream ones, there are other ones such as cryptocurrency. So you already know about Bitcoin, Ethereum. There's peer-to-peer lending. This involves lending money directly to individuals or businesses through online platforms. This can offer high returns, but it comes with a lot of risk. So those were basically all the avenues that you need to know about when it comes to investing. Now, which one should you invest in? Well, it depends, and it's down to you. Which one do I personally invest in? I keep it simple. I just invest in the stock market via an ISA, so a tax wrapper. I invest in real estate. But when I say invest in real estate, I buy a house to live in and I have one other property, and that's it. I'm very hands off. I don't really want to get too much into the details of the day-to-day life of tenants and chasing them up and stuff like that. I rather spend my time enjoying my time. And I invest in government bonds because those are the most secure, because it's backed by the government, and that's it. I don't really invest in peer-to-peer lending. I don't invest in cryptocurrencies. I don't trade futures. I don't even do individual stock picking. I just do index funds, bonds, and physical real estate. That's it. That's my 3 types of asset classes that I invest in, and I keep it simple because there is no need to overcomplicate this. Investing is about putting your money into a vehicle, into an asset, for it to generate income. So I advise you to look into whichever one that you feel comfortable with, whether that be the stock market, whether that be real estate, bonds, whatever you are comfortable with, and invest your money into that. You could go and open a farm if that's something you know about. Then go invest your money into that. You can open a business. Basically, there is no restrictions when it comes to investing. Investing is putting your money into a vehicle to generate income. So hopefully that clarified the jargons that are used in the world of finance when it comes to investing, and it simplified how you can invest and where you should invest. So if you found this video helpful, thank you for watching. Let me know in the comment section what you thought. Give it a like, subscribe, and take care.